Hello, fellow traders. 'Tis I, the Rumpled One. It is Wednesday, September the 5th, the year 2018. Let's talk trading. Grinding out the pips. If you look at the trading forums and read these guys, different traders and their systems, and you'll notice that many of them talk about hundreds of pips. Or if you get those ads in your email, if you get this special slope angle indicator or divergence indicator or whatever indicator, they promise hundreds of pips on these. The question is, do you really believe it? I mean, hundreds of pips? It's possible to make 100 pips in a day or two, but being able to place that trade in the right place at the right time, not experience enough drawdown to trigger your stop loss, and then you reap 100 pips or more, 200, 500, that's quite the accomplishment. If somebody can do that on a regular recurring basis, I'd like to see it. But for me, doesn't seem to happen that way. I can grind out the pips. I mean, I put trades on and I could be up 10 pips and I move my stop loss up to, break even +1, and then it'll come down and stop me out. And then sometimes it might go on for another 50 pips or 100 pips. So, it's a matter of timing, a matter of luck. Yeah, I could, leave my stop loss alone and then I might see a 10 pip winner turn into a 20 pip loser. I mean, is that smart? I don't think so. I mean, the name of the game is to win. And so, maybe I grind out some of those pips. Or maybe I do like my good trading buddy Wild Super taught me or suggested to me years ago, over a decade ago. It's, when we're trading stocks, you're up a nice profit. Well, you take half off, move your stop up, let the other ride. There's no reason to not take some profit, especially if you're a day trader. I keep mentioning these stops once again. It's the amount you're willing to lose per trade, because you put that trade on, you say, well, I think from this point, price is going to go up, so I'm going to buy. Or I think from this price level, price is going to go down, so I'm going to sell short. And, after you put that trade on, basically all you can do is watch. I mean, the only thing you really can control is the amount you lose. And hopefully, if the market gives you the opportunity to take some profit, you do so. And so, let's see, why is this back to dollar yen? We're gonna be looking at the euro yen. So let's go back here and look at the euro yen monthly. You see here it left that wick zone. So, that's a statistical trade. So we're like 67 pips above the bottom here, or the bottom of this candle, or as you can see, the top of the lower wick zone, now 66 pips. But you can see that was a nice move there. But maybe you only, maybe just ground out just a few pips, or right here, you can see here we popped out of that lower wick zone once again. You can see here 66, because the week and the month ended on the same day. And you can see here we shot into the upper wick zone of last week. And notice here all gaps have filled. And remember, yesterday I think I saw a 60 or an 80 here. So even though it was put up that late, we put that chart up on Tuesday. You see what happened? They filled. There was money to be made on those simple trades, filling the gap. And that's grinding out the pips, because sometimes those gaps are only maybe 5 pips. But 5 pips is 5 pips. You know, if you do that across 20 pairs, 5 times 20 is 100. And you can see here, we broke out of the daily. Right now we're 38 pips above with a potential here. It's like we had actually had a potential making 78 pips. Now that's not 100, but that's not a bad trade. And one of the things, if you notice about the euro yen, and I think I'll have to put up a chart so you can see the actual frequency distribution. You can see here it likes to break out of the previous day's high or previous day's low, and when it does, there are pips to be made, but like you can see here, it didn't do it, and here there was only a few, but here there was a few more. But if you take that trade, you know, on a regular recurring basis, you can grind out the pips. I mean, like right here, there really wasn't much. So if you would have stopped out at that wick zone, you could have made it up going the other way, just on that one simple trade, trading the previous day's high, low breakout, which is part of, it's like half of a wick zone trade. And you can see here we've got some nice ranges here on the euro yen 135 compared to the dollar yen 44. So you can see here things changed. That's why I've been observing the, you know, trading the dollar yen for months, but things seem to be drying up in the volatility or daily movement. So we moved over to euro yen this month, and you can see here, you know, that's what, 3 times the range. We got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 over 100 pips. And you see you got 1, 2, 3, 4 over 200 pips. Once again, action in the pound pairs. Lots of movement. So even if you look to grind out pips, sometimes you get lucky and you pick up a huge run. But for the most part, happy to grind out trades. The pips here, you see here we had the pivot point below the open, but we got a long trigger. Maybe you ignored that, saying, no, I'm going to wait for the pivot. But you can see where the pivot is. It's not too far below that short zone. So here there was a short triggered. There was a trade, long trigger, and huge profit if you stayed in it, stayed in the trade. Chances are, if you were smart, right here you would have exited. Worst case, exited there. Only giving back a few pips. And you see here it turned around and shot up through. Now, the one thing, it's above the buy zone. If you exit here, you could always put a buy stop right at that level. So if you think price could continue, you know, you exit, you bank the profit, you could put in a buy stop, and then once again, you would have the opportunity to pick up right where you left off. But there's no reason riding the elevator all the way down. And you can see here the rats got paid off. There was a, remember the rat zone would have been here, but a nice payoff right here. Rat reversal getting in at the 82 level. And you can see here, nice pips to be had. Okay, we took out the pivot. We saw that. And we hit the weekly pivot. It's always a target to look for. So from that, you know, from the open of the week, right here, we could have had a very nice, that's a hairy hindsight, but we know we like to trade weekly pivots, daily pivots as targets. So whenever you see price moving that way, you might want to jump in, and you might only grind out 3 or 5 pips before it starts the reverse, and you can get out, take those pips, and then when you see it heading back that way, you can jump back in. And once again, you see here we took out that missed pivot there. We still have one here, and it's 224 pips away. Who knows if it's going to hit it? I don't. We just have to trade, see what happens. And those other missed pivots are way back there. Okay, price action. You see there's the start here on the day. One ball at the bottom, green at the line. Two ball at the top, right? We go red at the line. Two ball, green at the line. Three ball, red at the line. I mean, you know, we do this every day, right? It's not difficult. Sometimes you just grind out a few pips on these volatile days. You can grind out, let's see here, 10, 20, 30, 40 pips. That's not a bad grind, right? When sometimes all we get maybe is, 10, maybe we only get 5. And so, just to be clear, had you taken this trade short, even though I would believe there would have probably been maybe a 1 ball or maybe the 3 ball there, I'm not sure. But had you taken this trade short and you exited, or if you took this trade short and you're wondering, as soon as you see green at the line, there's your clue to exit. So right there, that would have been 10 pips bagged right here. So those of you wondering when to take profit, I get that question a lot. So if you're trading this price action, or even if you might be trading something else to enter, but you could look at this price action to tell you to exit. You don't have to use the same method to exit as you do to enter. And here we're just trading candle color at the line. You know what to do, right? And here we've got the wick zones. As you can see, there wasn't hardly any space in that wick zone. You see here, basically a doji, right? So, but we know one thing, price doesn't like staying in the wick zone. So what do? We trade the breakout. And here we've got the holo set up from the get-go. Right there was the lowest. We put in a highest open. You can see here it made a high, failed to make a higher high, and just broke down. And that's good for what, about 30 some pips or more. Actually, you could have had a chance to take over 40 had you exited somewhere down here. Inventory reduction bars. There's a nice long trigger. You can see here short, just a couple of pips. I mean, if you got short here and then you stayed in, I mean, hey, right here, it's telling you it's coming back up. You got to exit. You just have to take those few pips. And it could have continued down, but you don't know. But when you see it waffling like this, no, that's when you exit. You see here, if you see it steady, lower lows, lower highs, yeah, then it's going down. But when you see this, it's starting to range. So you take what you can and get out. Previous daily, weekly, monthly, open, high, and low. Once again, we are just trading with the candle color at the lines. You can see here we've had some nice movement since I turned the computer on, watching this over the past few minutes. Einstein line, there was a trigger. You see here, just a couple of pips to be had. So, grinding it out. That's one way of trading. Because remember, it's not what you trade, it's how you trade it. So let's get out there and drain the banks.